Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
Here's the chart I wanted to show you on Eastern Europe, and I think when you look at this chart and you hear about what's going on in Eastern Europe, this chart alone should give you an understanding of the incredible financial pressures on Eastern Europe and the incredible exposures that the European banking system has to Europe. Let's look from here over, okay, before the credit crunch kind of hit here. Just look from here back. All right, everything's going along swimmingly, doing fine. You had the Hungarian forint on a relative basis compared to the Swiss franc, and again they were borrowing the Swiss franc in Europe because it was being lent. And if we go back on a relative basis at the time, we had 2.8%. Now it looks high, but back then it looked fairly low. So you had borrowing at 2.8%, because Hungary was they were probably up around 13-14% at the time. So if you borrow at 2%, and you can reinvest at 13% in Hungary, and your asset classes are going up, you're feeling pretty good. So they were making that trade all day long, and the banks were enticing them to make that trade. So here you saw the Hungarian forint appreciating against the Swiss franc. This shows that it takes fewer Hungarian forint to buy one Swiss franc. Therefore, the Hungarian forint is appreciating against the Swiss franc. Then all of a sudden, this little thing called the credit crunch hit. And look what happened to these guys. You went from that's 140. It took about 140 Hungarian forint to buy one Swiss franc. All of a sudden, it takes 214 at the top of this, 214 Hungarian forint to buy Swiss franc. Now, that's a 52% depreciation in your currency. So you borrowed Swiss franc, and all of a sudden, your mortgage is denominated in Swiss franc each and every month. And this hits you. Your mortgage just went up by 52% just by the currency devaluation against the Swiss franc alone. So if you figure there was a massive amount of Swiss franc borrowing going on, not just in Hungary, but also in Poland, also in other, Latvia and other countries were borrowing Swiss franc to make this trade, and some, and even some euro too, because on a relative basis, the euro was a lower yielding currencies, but Swiss was the borrowing of choice. You can see the pressure now, not only on the the average guy that borrowed money to invest in his home, but on the institutional players that did a lot of building in these countries, just crushed. And the banks, of course, are now stuck with these loans in Swiss franc that a lot of people are defaulting on in Eastern and Central Europe. So that pain flows directly back into the European banking system, which we think ultimately is going to hit the euro, when it all hits the fan. But that's the pressure. Just looking at the currency move here in the leverage trades, the carry trade of the Swiss franc, you can see now the pressure that it's created, I think, on the Eastern European countries. So what are the problems with the carry trade? We know what the good thing is. The good thing is you can make a bunch of money if you get it right. But the problems are this. It really engenders risk-taking and really complacency. When you have asset markets that are in low volatility and moving up, people think it's always going to be the case. As far as the eye can see, low volatility will be here. As far as the eye can see, liquidity will be here. So it engenders this risk-taking and complacency, and you get what we call bubbleology. We saw it in the asset markets. It creates an amount of leverage in the system that wouldn't be there otherwise because of these yield differentials and this ability to borrow cross-border. It leads to really currency distortions. It means, for example, we think the yen very much got out of line in the midst of all these borrowings because it was just pushed down, pushed down, pushed down. It was pushed out of line relative to its fundamentals, Swiss franc too, and maybe the same thing's happening now with the dollar. In fact, we happen to think that is happening now with the dollar. We're getting some currency distortions. We think the weakening of the dollar over the last few weeks, maybe months, is more related to this carry trade going on in the BRIC countries back into the emerging markets than it has anything to do with this idea that the reserve currency status is in trouble or there's inflation, because we haven't seen inflation. So we think we're seeing a currency distortion intermediate term in the dollar, but we saw it in the Swiss and we saw it in the yen in the midst of all these borrowings. So it pushes things out of line with their fundamentals. Not only pushes the currency out of line with the fundamentals, but it pushes the asset classes out of line with their fundamentals. It creates bubbleology because you have so much money that's created by a carry trade going into these various asset classes, they get very much out of line with their valuations. And that's what we saw in the credit crunch, when people realized how out of line with their valuations. Oil at $147 a barrel was really a wonderful example. And then oil going back to $30 a barrel gives you an idea how out of line oil was with the underlying fundamental supply and demand conditions. And all of this really was created because of just the incredible loose loose monetary conditions from either regulatory standpoint or ability to create all these derivatives. And the derivatives creation came because of these giant yield spreads. Part and parcel of that. There were other factors, needless to say. Problem with carry, as I said, it cuts across all asset classes and it creates distortions, as I just said. And it leads to massive leverage in the system, much more leverage in the system than you would get normally because of the ability of the lenders to fund these carry trades. Excuse me. And this is what we've also seen because of this carry trade problem, creating all these bubbleology and valuation distortions when things change. Because the way the financial, there's really two economies out there. There's a financial economy and there's a real economy. Often the two don't meet. Often they do, because the real economy is often built on collateral values in the financial economy. The stock market, for example, is a repository of collateral values for different loans. So when you get this massive leverage, you tend to get a false signal sent to the real economy because you have a lot of collateral that's built up on all this leverage that's pushing things out of line with valuation, which feeds in the real economy. And Main Street gets out of line with its valuation, housing, for example. So when you have a break in financial markets because of these distortions created by carry, it transforms very, very quickly in the real economy, and that's how. And we're now dealing with that transmission to the real economy, soaring unemployment rates and capacity utilization down, and people pulling in their horns everywhere as the market tries to reset the values that were driven out of line in a big way by carry. So that's one of the biggest problems of the carry trade that we see over the years. That's created more problems in the system than we've had in the past. Not to say these systems would not have developed without the carry trade, but we think it's enhanced it in a very big way. So what's the game changer here? The game changer here is the credit crunch on the carry trades. You have the low borrowing rates still, but the reality is the access to the credit has changed. Just because, again, we have low borrowing rates doesn't mean the bank's going to lend it to you. Even if you can show decent credit standards, sometimes the banks aren't going to lend it in this environment because they're saving themselves and credit's still tight. That's why we're seeing very high reserves on the balance sheets of the banking system. Money's just sitting there on the bank balance sheets. They're not lending it out. They're not lending it out because, number one, they're having trouble finding credible borrowers, and number two, even when a borrower comes in, the bank may create a situation in which they don't become credible borrowers because they want to keep the money. So that's another part of this where the credit crunch has changed it, even though we have low borrowing rates. Number two, low volatility. Obviously, we've seen massive volatility in these markets, especially in the currencies. It's been as volatile now as it's ever been. Steve can speak to that with some numbers. That high volatility then changes the game. Low volatility is a big part of this process. You're definitely still seeing some potential weakness in some of the funding currencies, but it's volatile, and we're seeing ups and downs, backing and filling, and some big daily moves. That doesn't make for good carry trade raw material. We're seeing lately we've seen some lower volatility in the stock market, measured, I guess, by the VIX. We could use it. Again, Steve's better at this stuff than I can, and he can speak to that. But obviously, we've seen strength in the investing asset classes. Offshore, the commodities have done well, but the emerging markets have done very well. As I said, the BRICS and some of the emerging market classes up 50%. That move has been fairly low volatile, and a fairly low volatility and almost straight up.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.